I heard a couple of gold industry experts call IAMGold super cheap and a huge takeover candidate. So in this video, we're going to do an analysis of the company to see whether it's a buy right now. They have a world-class tier 1 gold mine that they're about to pour their first gold on in Canada, and every gold major is going to want this mine. However, the company has a lot of debt. So it's very important that we look at what their revenues will be coming up, what their expenses are going to be, and whether or not that debt is going to be a problem. By the way, don't take this video as a recommendation to buy or sell. This is just my opinion based on my own analysis. And also, you should always do lots of your own research before investing any money at all. IAMGold trades on the New York Stock Exchange under the ticker IAG, and today it's trading at $3 per share. The company currently has 2 producing mines, one big mine in Burkina Faso and a second smaller mine in Canada. The company's midpoint guidance for 2024 based on their producing mines is 460,000 ounces at an all-in sustaining cost of $1,860. Now, this is a very high all-in sustaining cost. However, the company is going through a really big change right now, and for the last 4 years, they've been building the Cote Gold Mine in Canada. This is a world-class tier 1 mine that all of the big gold companies are going to want. And after it's all said and done, this mine will have cost about $3 billion to build, and to start out, it's going to be producing about 500,000 ounces a year. And IAMGold owns 60% of this mine with the option to take their 60% up to 70%. So now let's take a look at how much money IAMGold is likely to bring in this year. First, we're going to look at their already producing mines that are producing 460,000 ounces this year. And of this 460,000 ounces, they have 60,000 of this hedged, which means they're going to sell 60,000 ounces for between $1,950 an ounce and $1,975 per ounce, which means if they hit their midpoint guidance on all-in sustaining costs on this 60,000 ounces, they're going to make between 5.4 million and 6.9 million. And now let's take a look at those other 400,000 ounces. So we don't know what the average gold price is going to be in 2024, but I have on the low end, 1,900, in the middle, what the gold price is approximately today, 2,150, and at the high end, 2,300. So assuming they hit their midpoint all-in sustaining cost number, at $1,900 gold, they're going to make $16 million. At today's gold price, they're going to make $116 million. And at $2,300 gold average, they'll make $176 million. So depending on what their all-in sustaining cost is for 2024, and depending on what the gold price is, they're going to make somewhere between $21.4 million to $182.9 million. Now, this number is what they're going to earn after taking into account all the costs of producing that gold. However, they have a lot of other expenses, and they have debt, and they have interest payments, and all sorts of stuff that we're going to get into. So we're going to look to see if this is going to be enough to cover the expenses that they have coming up. And now let's take a look at their new Côté mine. Côté isn't going to have a full year of production until 2025. So 2024 is the year where they're going to be pouring their first gold, and they're going to be ramping up to commercial production. Now, the company's guidance for IAMGold's portion of what they expect to produce this year is between 132,000 ounces and 174,000 ounces. Now, if we go to this lower end, costs are going to be higher because the fixed costs are spread out over fewer ounces, which raises the cost up. So my best guess is that if we hit the lower end of guidance, the all-in sustaining cost is going to be somewhere around $1,300, whereas if we hit the top end of guidance, the all-in sustaining cost is going to be somewhere around $1,200. And then in 2025, when we're in full production, the cost should be somewhere around $1,000 an ounce. So over here on the left-hand column, I have what the average gold price might be over the course of the 2024 production of Côté. So if we come in at the low end of guidance at $1,900 gold, we're looking at the company making about $79 million. Whereas if we come in at the high end of guidance at $2,300 gold, we're looking at the company making about $191 million. By the way, next year in 2025, assuming the company still owns 60% of Côté and not 70%, based on today's gold prices, Côté should be earning them about $300 million a year. So IAMGold's 2024 cash from operations should be somewhere between about $100 million to $375 million. Now that's a really wide range. However, there's a lot of question marks about what production is going to be like and also what costs are going to be like. Before we move on to talking about their debt, I want to tell you a little bit about this Côté mine. Right now, they currently have 17 million ounces of gold there in the measured and indicated categories. So those are high confidence categories, and then they have more ounces at lower confidence categories, but that number is going to grow a lot. And also their current life of mine is 18 years, which makes it a very high producing mine with a super long mine life. And looking at this graphic here, you can see the Côté deposit on the left and the Gosselin deposit on the right. And there's a space in between these two deposits that they haven't drilled yet. And they're going to be drilling that this year. And if they can show that there's mineralization between these two deposits, well, then this isn't going to be two big deposits right next to each other. This is going to be one giant deposit. And also, these Côté and Gosselin deposits are open at depth, meaning they don't know what's down there. So this year, they're going to be putting some deep drill holes in the deposits as well to see what's down there at depth. But to sum it up, this is already a world-class gold mine, and it looks like it's going to get a whole heck of a lot better. And I could see this mine eventually producing close to 1 million ounces per year, which would make it one of the world's biggest gold mines. And there aren't a whole lot of world-class mines in world-class jurisdictions like Canada that aren't already held by a major gold miner. So that's why IAMGold could be such a big takeover candidate, because I guarantee you that every major gold miner wants this Cote Gosselin mine. So now let's take a look at their cash and their debt and their interest payments and their other obligations. At the end of 2023, IAMGold had cash in the bank of about $367 million. And in addition to their cash, IAMGold, a little while back, sold one of their assets that they haven't yet been paid for, so they should have another $84.4 million coming in. That should be coming in Q1 and Q2. Now, this is no guarantee until they actually have that cash in hand, but that would put their cash total at $451 million. Even though the Côté mine is about to pour their first gold, they have said that they should be pouring their first gold near the end of March. There is still some more money that needs to be spent there, and IAMGold's portion of that is $142 million, which brings their cash down to $309 million. And now looking at the debt, this is where things get scary. So they have this $400 million term loan that has an interest rate of the secured overnight funding rate, which is currently 5.31, plus 8.25%, which puts the interest rate currently at 13.56%, which is $54.2 million a year just in interest, and that's not even paying off their principal. So this term loan is going to come due later in the decade. I believe it's 2028. And after that $54.2 million in interest, that brings their cash down to $255 million. Oh, and one of the covenants of this term loan is that the company's cash balance cannot fall below $150 million, which is going to put an additional constraint on their cash. And in addition to that term loan, the company also has $450 million in senior notes, which have an interest rate of 5.75%. So their 2024 interest payment on the senior notes is going to be $25.9 million. And these senior notes are due in 2028. Fortunately, the company has extra liquidity in their credit facility. It's a $425 million credit facility that's mostly undrawn. So they can draw about another $387 million on that credit facility if needed. And that's going to carry an interest rate somewhere around 10%. And the current interest that they're paying on that per year, my best guess is somewhere around $4.5 million. However, this credit facility says that the company must maintain an EBITDA to interest ratio of at least 3-1. And if they do not, they cannot draw any more money from that credit facility. And currently, their EBITDA to interest ratio sits at 3.73-1. So that's getting dangerously close to this 3-1 level. If their EBITDA falls very much at all, or if the amount of interest they're paying rises very much, or a combination of the both, they may not be able to draw from this credit facility any longer. So that's a big risk. And next, their G&A expenses for 2024. Here, I am not including share compensation because that's not a cash expense. I want to look at how much cash they're going to have to pay their debt obligations and to pay their Côté funding obligations and any other obligations. So I'm excluding share compensation for that reason. And in 2024, I think the company's G&A is going to be somewhere around $41.8 million. To help IAMGold fund the building of Côté, well, they sold forward 150,000 ounces of gold, and they have to deliver 75% of those ounces in 2024. That's going to be in quarter 2, quarter 3, and quarter 4. And this is going to cost them $217.5 million, which now brings their cash negative. And remember, because of this term loan, their cash cannot go below $150 million. So the moment it's about to go below $150 million, they're going to have to draw further from this credit facility if they still can. Now, I'm sure the company would say that this isn't debt and that this is just going to be subtracted from their revenue over here. But potato, it doesn't really make a difference. Like, I consider this to be debt because they contractually have to deliver 150,000 ounces and 3/4 of that in 2024. And now let's look at page 102 of their quarter 4 2023 management discussion and analysis. If we look at the commitment section, under the column where it says 1 year, that's what's due in 2024. Now, 2 of these items are capital expenditure obligations and lease obligations. And I'm pretty confident that those 2 apply to what they have to spend at Côté. However, in addition to that, they have a $196.8 million purchase obligation. Now, the truth is, I don't even know what this is, but this is a huge expense. This is a huge obligation that's due in 2024. But if any of you watching knows what this $196.8 million is, please let me know. But for now, since I don't know what it is, I have to include it here. So after looking at all of our 2024 cash expenses, that leaves us with a negative balance of $231.2 million. But remember, because of this term loan, the cash balance cannot go below $150 million. So we have to come up with $381.2 million. And how much are we going to earn from operations this year? Well, it could be as little as $100 million. So that leaves a big potential gap here. Now we do have $387 million available on the credit facility, which covers this with just a few $1,000,000 extra. So it just barely covers it. However, remember, we're getting dangerously close to not being able to draw from that credit facility because of not meeting those covenants. If the EBITDA to interest ratio goes down much at all, they won't be able to draw from that. But right now they could. So they could draw from that to pay this $381 million. However, they might not be able to. So that is really, really scary. So let's say the company is able to draw on that credit facility and fully draws it down. Well, then that's going to bring the company's debt to $1.275 billion with an annual interest payment of approximately $122 million. So depending on the gold price and depending on the company's costs this year, they may not even make enough money to cover the interest on their debt. So this is a really, really big concern to me. And despite what I just laid out with their debt, and their interest payments, according to them, that's not even the company's biggest risk. According to the 2023 annual report, they said the successful completion of construction of the Cote Gold project on time and on budget, along with the successful commissioning and ramp up of the mine, is the single most critical success factor for the company. Now, they put that in big, bold letters in the annual report. So that tells me that they're not super confident that they're going to be able to commission and ramp it up exactly how they expect. And there have already been delays with this build, and they've already gone way over budget. So what if they go further over budget? And instead of this $142 million in Côté funding, they have to come up with even more cash than that. That's a real possibility as well. So the company is going to have a tremendous amount of debt at very high interest rates. But they want to get their Côté ownership back to 70%. Right now it's at 60.3%, and they want to buy back that other 9.7%. However, that's going to cost them a lot of money. And management has said that after Côté is in production, their number one priority for cash is not paying down debt. That's not what they said. They said their number one priority for cash is to buy this back, to buy back that 9.7% to get their Côté interest up to 70%. So now let's look at how much that's going to cost them to buy that back. So with this deal they have to buy back this 9.7%, they can do it on 2 dates each year, May 30th and November 30th. And they have to give the other company 60 days notice that they're going to buy it back on that upcoming date. And their very last opportunity to do that is November 30th, 2026. So here's the terms on which they can buy that back. So they have to pay back $340 million plus an interest rate of the secured overnight funding rate, which is currently 5.31%, plus 4%, which currently is an annual interest rate of 9.31%, which would be $31.7 million for each year that it's not paid back, and that interest has already been accruing for a little while. And then from that, you subtract the value of the gold that other company received based on 9.7% of the gold until commercial production, which I estimate would be about 13,000 ounces, or at today's prices, worth about $28 million. So now let's look at IAMGold's cost to buy this back. I think the chances of IAMGold buying back that portion in May of 2024 is very low. So I think the earliest they would possibly consider buying it back would be November of 2024, at which time it would cost them approximately $367.4 million. Or if they waited until November 2025, that would cost them about $399 million. Based on all of the debt that they have and that they're going to have, and based on their interest payments and all of their expenses in 2024, and compare that to how much money they're earning, I don't see how they're going to buy this back. At least not in 2024 or 2025, unless they're somehow able to get out another loan, but they're already paying huge interest rates. And who is going to loan them even more money? I don't know. Now, maybe they could sell a royalty or a stream to one of the royalty and streaming companies on a portion of that 9.7% and use that to buy it back. But other than that, I just don't see how they're going to be able to make this payment. So for the time being, I think they're going to be stuck at 60.3% ownership of Côté. So far, we've seen some of the risks that the company faces, but before I talk about valuation and whether this company may be a buy or not, let's talk about other risks that the company face. So we already talked about the huge debt and huge interest payments that they have and are going to have. And another risk I already touched on is their ability to draw from the credit facility. Their EBITDA to interest payment ratio is getting dangerously close to that level where they can't draw from this. Because they're a company with high cost mines, they are very leveraged to the gold price, which means if the gold price falls very much at all, well, then that's going to affect their EBITDA a lot, which could put that ratio below that number that allows them to draw from that facility. So I see that as a pretty big risk as well. And on that point, another risk is their high cost mines. We've seen from a lot of different companies who have high cost mines like this. Quarter after quarter, they're delivering bad surprises and their costs keep increasing. And when you have high cost mines, you're even more susceptible to increasing costs. So this is a big risk as well. And they don't have very big margins at their two mines that are currently producing. Another risk, according to Standard & Poor's, their 400 million term loan has an S&P rating of triple C, meaning that it's vulnerable to non-payment. That's a pretty bad rating on that loan. That's why the interest rate is so high. That's why they're paying an interest rate of over 13% on that. Another risk that the company faces is that they're in a very risky business and they only have 3 assets. Well, 2 producing assets, soon to be 3 producing assets. And if anything bad happens at one of these assets, if any one of them gets shut down for any reason, well, that could be a death blow to the company. And another big risk for the company is that 360,000 ounces for 2024 are produced in Burkina Faso, but not just in Burkina Faso, in a part of Burkina Faso that's really dangerous right now. So dangerous, as a matter of fact, that they're not even driving their employees to the mine site. They're flying them in by helicopter because of how dangerous it is on the ground there, and they're having to spend a bunch of money on security. They've been able to keep that mine operating uninterrupted and have been able to continue getting supplies in, but this is a very, very unstable political jurisdiction right now, especially the part of the country where that mine is in. And that's their main mine right now. That's their main cash flowing asset. So that asset is very, very important to them. And I think that if this asset gets shut down in 2024, that the company is screwed. The company has too much debt. They have too many obligations, too many interest payments. They need the cash flow from this mine. So I see that as a big risk as well. IAMGold has a separate development project that they owned 75% of, but recently they acquired Vanstar, which was the owner of the other 25%. So now they own 100% of that development asset. And after the Vanstar acquisition closes, the company is going to have 493.2 million shares outstanding at $3 per share. That puts the current market cap at $1.48 billion. And although that's the market cap, the company also has net debt of about $379 million and those forward gold sales, which is a liability of $297.7 million, which means the market is valuing this company as a whole at $2.157 billion. And compare that to the company's net asset value, which is approximately $1.7 billion, which means they're trading at 1.27 times NAV. Now, in fairness, Côté is going to grow a lot, and that NAV of that is probably going to increase a lot as well. And when they calculated that NAV, they were using $1,700 gold in the first 2 years and $1,600 gold in the years after that. Obviously, gold is significantly higher than that right now, which would increase the NAV a lot. But they have to be conservative with these numbers because we don't know if gold is going to stay at elevated prices like that. And also in that, they were using a 5% discount rate. So using a 5% discount rate to calculate the NAV when the company who holds that asset is paying over 13% interest rates on some of their debt, you can't use a 5% discount rate when you're paying 13% interest rates. And now let's wrap this up talking about my target price, what I see the risk level as, and my verdict, whether that's sell, hold, buy, or strong buy. I definitely see IAMGold as a takeout target, and I think they should be taken out because I think they have too much debt. I think their balance sheet is in too bad of condition, and I think they need to be taken out or merged with a company that has a better balance sheet. But any mid-tier or major gold company in the world wants this Côté mine. Everybody wants production in Canada, especially to have a tier 1 mine in Canada. And as I mentioned earlier, it's one of the only tier 1 mines available in the world in a premier jurisdiction that isn't owned by a major. Definitely a takeout target, and I hope for shareholders' sake that they do get taken out. I think you know by now that I think this is a very risky play. For them to meet all their obligations, there's a lot of stuff that has to go right. The gold price has to stay high. They have to deliver Côté on time and on budget and operating at reasonable cost. And then everything has to go right in Burkina Faso. And hopefully they can continue making improvements to their other small mine in Canada so that mine can earn a little bit of money this year. And then there's a million other things that could go wrong with their balance sheet and the debt that they have to pay. So on a scale of 1 to 10, 1 being the least risky, 10 being the most risky, I'm putting this at like a 9. I think it's extremely risky. And as for a target price, I'm not putting the target price higher than the current stock price. I got to put the target price as a discount to NAV. I'm putting the target price at $2. And verdict, because my target price is lower than the current stock price, my verdict is a sell. Again, this is just my opinion based on my own analysis. So always do lots of your own research before investing any of your money. There's a lot going on with this company and the financials are very complicated. It took me a lot of time to learn everything about all these different covenants and this forward gold sales and their hedges that they have and things like that. It's definitely the most complicated analysis that I've done. And I don't like analyses to be complicated because that means it's harder to understand. If it's harder for me to understand, it's going to be harder for the market to understand. I still think they're a takeout target, and maybe shareholders here make some money if everything goes right. I mean, if everything goes right, yeah, you're going to make money. But I think they should be taken out by a bigger company or merged with another company who has a better balance sheet and also profitable production. Anyway, if you found this helpful, please give it a thumbs up and subscribe to the channel because I'll be making more videos like this. And let me know in the comments what company you would like me to do next.